So today's topic, we're gonna to talk about the bad debt and allowance for doubtful debts. So what does bad debt and allowance for doubtful debts means? Bad debt, normally it will happen when some of our customers who take on credit, they will not be able to pay their the payment which they have to pay. Let's say some of our customers before the coronavirus or before the pandemic, some of the customers, they were taking on credit, then suddenly this pandemic happened, the crisis happened, they are not able to fulfill their obligation. Or we can say like, okay, I have a company here in Malaysia, I was selling overseas, so one of my customers is in China. So somehow I know that the economy in China is very bad nowadays, so I can expect that this company maybe will not be able to pay their balance. Or maybe I can take it as I hear some news about some companies that they are not able to pay, so also I can consider, and they are my customer, so I can calculate allowance for doubtful debt to make sure that to not get issue suddenly. Because if we didn't create the allowance for doubtful debt and suddenly all our debt or big portion of our debt gone, it will be big loss for that year. So always when we are having we are thinking that there is a bad debt gonna to happen, so it's better we protect ourselves by using taking or calculating the allowance of doubtful debt. So in your daily life, have you ever experienced lending money to your friends and the person didn't pay you back? Yes, this one is called bad debt. So this chapter is going to explain the term of bad debt and discuss accounting treatment for the debts. What is a bad debt as definition? A bad debt is a debt by a customer, an asset to the business that is almost certain cannot be collected. Whenever a bad debt occurs, a debtor account should be closed. So whenever bad debt occurs, debtor account should be closed. There are many reasons why bad debt may happen. Either the debtor may have passed away, the debtor may have become bankrupt, the debtor may have disappeared and cannot be connected, the debtor simply cannot afford to pay anymore. So those are majority main cases of why bad debt may happen. The bad debt account must be charged as expenses in the statement of profit or loss or other comprehensive statement which got in the income statement. The double entries are as follows. The debt is bad debt account. The credit is respective debtor's account. So normally this is the entry which we do. We put the bad debt in the debit and we put the debtor or the account of the debtor. Let's say I have a customer, his name is Ali as example, and I know this Ali that he is now bankrupt and he cannot pay. So how I can record this one, register this one. So this is in case the customer gone bankrupt, cannot happen at all. So we put like debt, debt which is bad debt, and the credit which is Ali. In case my customer, his name is Ali. Okay. So this is how we record the bad debt. Then we need to close this bad debt account. Okay, so in this transaction we created bad debt account and we close account of Ali. The second step, we need to close this bad debt account. Where we close this bad debt account, we take it to the income statement. This one, we close it in the income statement. Okay, how? By writing that income statement, or we call it statement of profit and loss, or loss and other comprehensive income. The credit is bad debt account. So when we make sure that one of our customers is gone as a bad debt, what we do, first transaction we do, it is debt, bad debt, credit, the name of the account of the customer, which is maybe accounts receivable. Just 1 minute. So we have accounts receivable. Then we need to close this one. We close this one is closing for the customer account. So account receivable, or we can put like Ali, or what is the name of the customer. Okay. Then we need to close this bad debt account which we open. Normally we close it in the income statement. So to close it, we put it credit bad debt. And the debt side will be the income statement. Or what we call it profit and loss statement, or other comprehensive income. So like this, we record the bad debt when it's happening, and then we close it in the income statement. Okay. Summary: first transaction should be debt, bad debt account, credit, debtor account. Then you see how we put this one in our T account. This one is like T account. Okay. Second transaction is we close the bad debt account which we created in the PLOCI, which is profit and loss, profit or loss and other comprehensive income. Okay, and the bad debt, and then like this, how we put this account in the income statement, or what we call profit or loss and other comprehensive income. So let's go for the allowance of doubtful debt. When we create allowance of doubtful debt, the first one, when dealing with bad debt, this is when bad debt happened already. So now we know that this customer is gone as bad debt, so we have to close his account. The second step which we are discussing, or second topic of our today, is how we create an allowance for doubtful debt. So these debts are not yet gone bad, but there is possibility, we are doubtful about it. There is possibility that they are gonna to gone bad. So what is our action should be? Okay. So the business may estimate that some debt may go bad in the foreseeable future. For example, a recession may be forecasted in the forthcoming year, and some customers are expected not to be able to pay next year. This estimate is known as allowance for doubtful debt. It means we have to protect ourselves from possibility of some of our debts may be gone bad. Maybe they're gonna bad, okay? So a provision for doubtful debt is in fact a loss or an expense to the business, and should be charged to the accounting period during which the credit sales take place. In accordance with the matching principle formula, allowance of doubtful debt is a percentage of the accounts receivable minus bad debts. Why we do put minus of bad debts here? Because those already gone from our accounts receivables. Okay, so for that reason we don't calculate allowance for bad debts which are already gone, because this amount we're going to close it in the profit and loss and other comprehensive income. Okay, so for that reason, how we do, we just create allowance for the balance. The balance which being left for next year. So we have to create allowance for it, just to protect ourselves from the possibility of maybe some of these customers they were gonna as a bad customers, or sorry, as a bad debt. So the way to record, how we can record the allowance of doubtful debt, when the allowance being created, we put the debt is profit and loss and other comprehensive income. The credit is the allowance. Again, to create the allowance. So this is the first record for the allowance. First time we are recording the allowance, we will take it in the, we will put it in the credit side. Okay. From where we put it in the profit and loss income, and then this one for creating. Then to close the allowance, the balance of the allowance will show in the balance sheet. The balance of the allowance will show in the balance sheet, and this allowance will be keep till next year. Okay. Then to increase the allowance, we know the nature of this allowance, it will be the credit side. So when we want to increase it, also we put in the credit side with the difference. When we want to decrease it, we will cannot put in the credit side. So when we increase and decrease here from year to year. So let's see, the first year we decided to take allowance 1,000 ringgit, okay? And this allowance, we kept it. For second year, when we calculated the percentage of our, the percentage which we want to take it from our debts, we reached to amount only 900. So we have 1,000, but we need only 100. It means we need to decrease the allowance. So we put the allowance in the debit side to decrease it. When we return this money to the BL, profit and loss and other comprehensive income. Okay. Let's say the previous year was 1,000, and when we calculate the percentage of this year, we see the amount, it will be 1,100. So again, we do same transaction, which is the debt, which is the profit and loss and other comprehensive income, and the credit will be the allowance. Okay. So this is the things how we can record the allowance of the allowance of the doubtful debt, and how we can put it in where it should be located. Okay. So as summary of what we were saying, for first time when you want to create the allowance of doubtful debt, you have to put debt, which is profit and loss and other comprehensive income. Credit is the allowance, and it will show like this when you close the transaction. When you show you post the transaction in the ledger. Sorry, just okay. Then in the next year, when you want to increase, so you will add also, again, you will write from debt, profit and loss and other comprehensive income, and credit is allowance. If you want to decrease, you will do the vice versa transaction, which is debt, allowance of other allowance for the doubtful debt, and credit is the profit and loss and other comprehensive income. So the balance, as I mentioned earlier, the balance of the, let me write it for you here as a note. So, oops. Okay, just 1 minute. Okay. So the allowance, the balance of it will show in the balance sheet, okay, which is our financial position statement, okay? We call it the balance sheet. So the balance of the allowance should show in the balance sheet. So let's say after we created an allowance for doubtful debt, or after we already wrote a bad debt. So the things we have learned today, we have learned two things. First, when one of the debt is go bad, how we can deal with it. We will just decrease the amount of our debt, or we close the account of that customer. So we put debit, bad debt, credit the account of that customer. Then we close the bad debt balance in the profit and loss statement, which is a profit and loss or other comprehensive income, or we call it the income statement. The second step we learned is how to create a allowance for doubtful debt. We said why we create allowance for doubtful debt for this debt which is possible to go bad by next year. So we want to make sure that we don't put ourselves in trouble. So for that reason, we create that allowance. How we create it? Normally, this allowance it will be debt. The allowance it will be debt. The allowance credit. The balance sheet, or sorry, that the allowance, credit, the profit and loss and other comprehensive income. This we want to create it. When we add on it, again, we put the debit, allowance, credit, profit and loss or other comprehensive income in the balance. The difference between what is the balance we have and what we want to have. If you want to decrease it, we just put the vice versa. Then the balance of the allowance of other doubtful debt, the balance will show in the balance sheet. So we have one possibility is when the bad debt gonna to recover. After we had the bad debt, after we have a bad debt, after we already wrote, if you remember, the first transaction we write when we want to register or record the bad debt is we put debt, bad debt, credit, the customer account, okay? So bad debt recovered are payments received in the respect of debt that after they have been written off. Though this one, we call it that writing off the customer or the account. Like we already closed this account, we consider it as bad debt. So maybe let's say this one happened in 2016. Maybe in 2017, the customer become better. Maybe he disappeared for certain circumstances, then he come back. So he want to pay us back the money. So how we can do this could be due to the variety of reasons such as better trading results in the future and so on. So how we record? The steps to record bad debt recovered as follow. First, reopen the debtor account to record the bad debt recovered. If you see, this is the account which we closed. This is the customer account, and this one the bad debt recovered. So again, the customer account is by nature is asset, so it will be debit. So we want to open it. We put it in the debit. The credit bad debtor recovered. Then record the amount received from the debtor. We put like cash to the customer. Then transfer the bad debt recovered to the statement of the profit or loss or other comprehensive income, or what we call it the income statement. So this is the 3 steps when your bad debt will be recovered. So what are the steps you do next? Like after you have already written off the account, the customer. If you remember here, we write off the customer account. We already close it. We have to open it again. So you know the customer by default the account it will be debt. So you want to open it. We have to put in the debt. Then the credit side will be that bad debt recovered. Then after we open the amount of the account of the customer, we record the money which we received. Like it means the customer is owe us some money. This it means the customer pay us the money. Then we will have the bad debts recovered. The balance of this one we close it in the profit and loss or other comprehensive income. Okay, this is we call it the closing entry. Okay, so this is the things which we normally do, the steps normally do when we have a bad debt recovered. So the transaction can be shortened. If you don't want to go all of this detail, you can just put from cash to the statement of profit or loss or other comprehensive income. Because if you not, how you can shorten it? Let me show you the shortening happening how. I will put it in blue color, okay? Because if you notice, we open the account of the customer, then we close it again here, right? We open the bad debt recovered, and again we close it here. So what is left? Left this one, which is how we receive the money in the debt side, and we have this one in the credit side, the profit and loss or other comprehensive income. So like this, we can just make it very short. Instead of writing first, second, and third transaction, you can write in the short way, which is cash, debit, and the profit and loss or other comprehensive income as credit. Okay, this is the way to record the bad debts recovered, so we can shorten it: debt, cash, bank, or whatever, credit, statement of profit or loss or other comprehensive income. This is explaining how you can just shorten it. You see, this is what I was explaining in the previous slide. So last topic left in today's class is also about creating allowance, and this allowance is for discount, okay? Because sometimes we think or we expect that some of our customers, they will look for discount to they do their payment. So we have to prepare ourselves earlier, and this discount should be taken from the profit and should be recorded in the year where this debt being created. So allowance for discount, cash discounts are discounts received or paid for promote payment. The discount is given by the creditor to encourage early payment. Allowance for allowance for discount allowable, which a business may give to its debtors. Some businesses create allowance for discount to be allowed on the accounts receivable outstanding at the statement of financial position date. By allowing for this, a better estimate of collectible debts can be made owing to cash discount, which will be given to debtors if they pay within a given time. Amount percentage of total good debtors minus bad debts and allowance of doubtful debts. So this is how we calculate the allowance for discounts allowable. Normally is the percentage of good debts minus bad debts, also the allowance of doubtful debts. Then we can create it. How we can create it? Same as when we are creating the allowance of bad debts, of doubtful debts. Also, the debit is the statement of profit or loss or other comprehensive income. The credit side is allowance for the discounts allowable. So the way to record the allowance of the discount, we call it like the same as we recorded the allowance for doubtful debt. To increase it, again, we do same. The debit is a PLOIC. The credit is the allowance. To decrease it, we just do vice versa. For summary, for first time, we put it. This is how we close the account. Okay. This is and the allowance for discounts allowable. The balance of it will gonna showing in our balance sheet statement, okay, or what we call it the financial position statement. So today what we have learned, today we have first learned how to deal with bad debt. If one debt gone bad, how we can record the transaction. Then second, to create allowance for doubtful debt, some debts which we're expecting to go bad next year, so we have to create allowance for it. Third, it was increasing and decreasing of that allowance. Fourth, we learned how to, in case some bad debt being recovered, how to deal with it. And also we learned how to create allowance for discounts allowable from our good debtors.